The second piece is where I talk about the opportunity itself. And like I said before, I'm not talking about a finite opportunity like a single family home or a single apartment or a short term rental. Here I'm talking about a big asset class. And this is kind of the path I took to get to where I am in terms of understanding where I should invest. So I was looking at several asset classes when I came into the space. It was all new to me. Like 5 years ago, it was like a totally new topic for me. And so I started to look at several asset classes. The more common ones those days were single family rentals, which I already had. So I knew that asset class very well, but short term rentals and apartments. And there was also self storage going on and some amount of industrial, but not like the way you see it now. So for any of these, the starting point in my mind is the economic drivers. What is driving this asset class? So if it is single family or multifamily, it is the demographics and the job growth and population growth in that market. So if you're in any multifamily situation, you need to have enough people there and enough people with jobs so they can afford to pay the rents you are charging. So that is for multifamily. For short-term rentals, it's very different, right? I mean, you still need tenants, but a different kind of tenant. They're short-term and they are not living in that area. But your economic driver here is tourism, right? And to go to another example, which I'm dealing with right now, this project in Puerto Rico, which we are evaluating, the driver is FEMA. It is government money given to Puerto Rico, some 20 billion, to rebuild a lot of their infrastructure around the electrical grid. So it's a totally different driver. Right. So when we look at the other project, there's a township in Louisiana. They have like 10, 15 projects there. A lot of that is government related, where they're dealing with the government on things that you wouldn't even imagine. They're in Louisiana that's coming up. And so there are some linkages with this property and the port. There is tourism because of how they are located. So there could be short-term rentals. So the economic drivers for these are different. And one more example here is we keep hearing about industrial warehouses. We've been hearing about industrial warehouses for a while, but recently Amazon got rid of or is planning to get rid of about 10 million square feet of their warehouse space. And so with all that going on, we now hear that there's more warehouse space needed for nearshoring companies, meaning companies who are moving their manufacturing businesses away from China and setting up shop in the US. So when we hear about economic drivers, we always need to double check because the folks who are pitching these investments to you could give you a rosy picture of all this. But the purpose of doing this is to kind of put at least some amount of time to do that analysis so that you are able to do that independent evaluation and not be really looking at just the rosy presentations that come to you or just pop up on your Facebook page every other day. So that's about the economic drivers. But any investment, and I'm not going into stocks and bonds, but at the core of that, there is economic drivers that people are looking at from a consumer behavior and all that. And we'll talk about that in the coming slides. The second thing to think about here is the demand and supply, right? So let's say we have a city which have got population growth. It grew from 5,000 to 10,000. We have a lot of jobs. There are employers coming. And the piece that was not shared with you or that you did not know, you did not see in the PowerPoint presentation was that, I'm just giving an example, I'm making this up here, 10,000 apartment units are being built in that city, right? So on one end, you're looking at all this and looking at the economic drivers. Hey, this is great. There's population growth, there's job growth. But then you also need to look at the demand and supply situations, right? So that's got a big part to play in any investment. The next piece would be the risk analysis and also the exit. So I'll talk about the exit and come back to it again later, because it's exit has to be planned before you buy the asset. Before you buy the asset, you need to have a sense of when you want exit that asset. Right. So, for instance, it's a good example is, we've been working with a company which operates farmlands and farm projects. There are lime projects where the company grows and ships limes to Walmart and Costco and all that. They also have coconut plantations, right? So when you look at it, if your exit plan is more like a 5 to 20-year exit plan, because by then lime is peaked, from whatever I heard, not even 20, by 15 years, it's reached peak production and it starts to decline. But coconut, it lasts for 60 years. So if you are in your 60s, right, unless you are planning to live another 60 years, you're not going to buy a coconut farm for yourself. But now your perspective may change if you're buying that for your children or your grandchildren, right? So this also ties back to your goals as an investor. What are you buying and for what and for whom? So those come into play and before you buy the asset, you should be thinking, who are you buying this for, right? And what is the plan with that asset? And in some cases, you want to come out quickly. And especially for a lot of the youngsters out there, the velocity of money is important. They can manage to take more risk and grow the money faster. So the exit is important. The other thing is risk analysis. So you need to do a lot of risk management. And the key things to look for is any legal risk, right? If you're going to buy a property, is that, can you really buy that property, right? So that is the legal risk. There could be some nuances there in terms of, we've had assets where you have something like a cell phone tower sitting there, or some easements with the city, and all sorts of legal aspects. And that is where our first phone call is to Sean. I don't know if Sean is still on the call, but our first phone call is to Sean, who is our securities attorney and real estate attorney, before moving forward with anything. But for any asset at a high level, you want to think about the risk from legal, regulatory, right? So when we talk about, just give you this this example of in Puerto Rico, right? We are thinking about the regulatory risk. I mean, how is the government, what is the level of involvement of the government? Is the money being allocated? Is there a reason for the government to drop the project? So those are some of the things. Then we talk about environmental risk. Is there somebody had underneath your property, if you have something like whatever diesel tank? This is a true story. Somebody was going to sell a property. He got it from his grandfather when he passed. And then they realized that there was some kind of a diesel tank which was buried underneath the property. And I don't know what that was used for, but there was oil there and whatnot. And so that became a huge environmental risk. And now they may spend more money fixing that than getting any money out of selling that. So there is the environmental, regulatory, legal sort of risk that you need to look into before even looking into the viability of that asset class. And depending on the asset class, it could change. So if for instance, if a short-term rental, the first thing I look for is that city in any way constrained by their regulations around short-term rental. Sometimes they do have clear guidelines, which is much better than in a situation where we don't know whether they have any guidelines. So they could change their guidelines come 3 months from now, 1 year from now. So each asset class has its own risk from a regulatory standpoint. So something to think about when you buy an asset. I got a call actually yesterday from Dubuque, Iowa, where they have some land for sale, which came up very quickly. They called me because they had a development which they were planning to do, and they sat on it for a while. It expired and whatnot. But the owner called me. They want me to buy it. But the underlying issue was that they had a tax liability. These guys were not paying the tax to the county for a long time. And so there was a tax liability, right? So these are the things that can come up, and you don't need to know all the answers for this, right? We have the experts to look into all these risks, but you should have these on your radar that, hey, if this is that asset class, I need to think about this risk. And depending on the asset class, the risk might be different, right? I mean, if you're doing something internationally, and I was working on a project in Kenya, trying to grow bamboo in unused sugarcane farms. It sounded nice, but then the country risk started to come into play, right? Just the political risk and then also the operational risk of that when you're trying to manage it from here and all that. So depending on the asset class and what you're trying to do, there's always risk. We need to do a thorough job of the risk management. And what I do is I call people, like I said, legal folks and other folks involved who've done this before, get their perspective so that you're not blindsided by this. So that's the other key thing I do. The next is looking at the financing structures, right? So some situations are where, hey, the opportunity looks great, but you won't get financing for it, or you won't get financing easily for it. Good examples would be manufactured homes. So in some situations, you don't get financing for it. Some situations, there are assets where it's very hard to find insurance for that asset. And just to touch upon other aspects, there are some asset classes where it is really hard even to find the right kind of property management company. So if you're buying a mobile home park, for instance, not many operators in the mobile home park that you can really, not very sophisticated. It's usually mom and pop and somebody living in the park who is managing it. And so there are those risks that come in. But again, going back to financing, we need to know whether it is financeable. What are the terms of the financing? Right, is very critical. And what do you need to do from your standpoint? So do you need to sign personal guarantees for these loans, or are these non-recourse, and who is backing it? And so there's a lot of that. The source of the capital also matters. So you don't want to get capital from some unknown sources, especially on long-term projects. When I say, long-term, I'm saying, even 4 to 5 years is long term if you're looking at an apartment or something. So you don't want to be in a situation where you got a loan from a not so great lender, and then 2 years down the line or 1 year down the line, they call your loan, right? And now you're scrambling. And so you need to understand the financing terms, but also understand the financing source, right? And there's also money that's out there coming from the drug cartels and all that. And so you want to just be very careful about where you get the money from as well. Then we have the financial return, right? It goes back to understanding just going back to the earlier point about what are your goals? Do you want cash flow? Are you looking at a outsized return? What is the IRR you're looking for? And I always talk about IRR because that to me is critical. So when somebody says that, hey, we invested 100,000 in this asset, we got 500,000. Okay, so if you got 500,000 after 10 years, not a big deal. I mean, it was just inflation that showed up as your 500,000. But if you got your 500,000 in a year, that's a totally different story. And so that is where the IRR becomes important than just the returns that people talk about. You really need to look at IRR because IRR brings in the time frame within which you got the return as well. And then I'll talk about one of the other assets where we got 110% IRR, but we had good equity multiples too. But I would always go for the IRR because that's, in my mind, a better indication of your return. So that's your return metrics that you need to look at. And as an asset class, you can as an asset class, know what the returns are typically. So farming, you don't get that kind of a high return. And in some of the farmland in US, you're thinking cap rates of 4% or something. So it's not a great return, but it's more steady. Some others promise higher return, oil wells, and other investments. But for each of these investments, which are promising a higher return, you definitely need to do more risk analysis and understand that asset class better before doing any physical due diligence. Okay. So now when we talk about physical due diligence, what happens is I go through all this and I'll show in the slides that come next that after all this analysis is when I even start to visit an asset. Visit meaning make a trip to see a few assets, right? So now, let's say apartments, I've looked at all this. I think that, okay, multifamily is a good space to be in. Then I start to see some of these apartments. Until then, there's no point in flying back and forth at the drop of a hat. Somebody says, hey, this investment will give you like whatever returns, and then you fly down to meet those people or see the asset, and then you come back and then you realize, oops, I didn't do the research on it, or when you did the research on it, things were off. So physical due diligence, in my mind, should be after all this, where you can do this from your home on your computer. A lot of this information is now available online, and I'll show those sources as well as we go forward. So that is when you go into your physical due diligence, see a few apartments or whatever that asset class is, and walking those, talking to those people who are with you, the managers, you get a sense of what are the things that can go wrong, and then it feeds into your risk analysis. Once you have a sense of, okay, this is the asset class I want to go in, then you put that in what I call a buy box, right? So buy box, an example of a buy box would be, hey, I would buy, I like multifamily, I would buy 150 Class A multifamily in Houston for like about 20 million or something, right? That's kind of where now you've narrowed it down. You're thinking that this is where I want to focus. Now you have your buy box. And then anything else that comes in, right? You don't want to get distracted, right? You know what you want to do that. So that way you are not pulled into so many distractions, so that you are not doing like 700 asset classes. You need to analyze asset classes all the time, right? Because you don't know what could become the next big opportunity. So you always need to be analyzing these asset classes and new opportunities at a macro level, meaning the asset class level, or some interesting project that comes your way. But don't spend too much money flying in and out and all that without really getting the preliminary understanding of the opportunity. So that's kind of where we get to the buy box. And I'll talk more about the buy box and the next steps as we go to the next slide. But I'll pause for any questions at this point. Okay, so this is kind of the analysis that I was doing before coming into making the decision of starting to buy apartments. And here, so I have this many number of cities, and these dates are a little wrong because I think this is when I moved all this to my new computer, so my new laptop, and that's why these dates are there. But these days go all the way back to 2017, 2018, and that's when at that point, I was analyzing all these cities because I didn't know where. I had a sense of where people were going, but I just wanted to get a big picture. So I put in the time to analyze a lot of these. And if I double click, this is a screenshot, but on my laptop, if I double click, each of these will have several folders there with opportunities that came to me from the broker sending me deals, and some of which we have underwritten, some of which we just did the city level underwriting and stopped. Some we stopped by just talking to other operators. Like, for instance, California was an easy one to not spend any more time on because of the regulatory and issues about doing business in California. And another one, Beaumont, is very much a hurricane-prone area. And so somebody sent me a kind of an offering memorandum of a property. I put it there, but after that, I didn't spend more time on Beaumont. So that is just that city level analysis, and I'll do an in-depth when we go to the next slides. The other is all these research related. So these are market overview type things. So here we talk about, all these people, all these reports out there. So you have Dallas, because there was a lot of focus on Dallas. That's where I bought my first asset, and so many of them sending more and more documents. And by then I had kind of zoomed down into Texas. So that is where you would see more. My focus is now more Dallas, Houston, Austin, like that. And then by about 2019 itself, I got out of the Austin market because of my research said that Austin is too overpriced, and so came out of it. And this one, again, what I'm saying is the analysis doesn't stop. So reshoring is a very new thing, probably maybe a year, not more than that, before it got some legs, people starting to talk about it. It started with the politicians. Some of the business folks started to pitch it, saying that there will be a lot more industrial warehouses needed because of reshoring. And I've been doing my research on the reshoring companies and trying to get to the actual companies which are really doing reshoring, the hype versus reality, as I call that. So that is some of the research that was done. This is just, just a sampling of the research that's gone into before picking an asset. And I will also share how it became useful when we made an amazing deal, and we exited an amazing deal in Augusta, Georgia. So that now we take